Imagine three Australians sitting at the same desk, earning the same salary and paying the same rent in the same city. They all managed to save the exact same amount every single month, but 30 years from now, their lives will look radically different. One will barely scrape together enough to retire. Another will be comfortable but always wonder if they could have done more. And the third will have built real, generational wealth. The only difference between them isn't how much they earned or how hard they worked. It's how they chose to invest that money. Today, we're going to walk through all three paths so you can see exactly where each one leads and figure out which investor you are becoming right now, whether you realize it or not. Let's start with the conservative investor. We'll call this path the safe road. At age 25, this person gets their first serious full-time job earning around $70,000 a year. They are careful with their money and not truly risk-averse. To them, the thought of losing even $1,000 in the stock market makes their stomach turn. So they do what feels safe. They stack their cash into a high-interest savings account earning around 5% per year. They leave their superannuation in a conservative option, which consists mostly of bonds and cash, averaging about 4 to 5% per year after fees. On paper, this sounds reasonable. The money is protected, it's predictable, and that predictability is exactly what makes it feel like the right move. Every month, they disciplinedly put away $500 into savings. But here is where the math starts to sting. After 10 years, by age 35, they've saved roughly $77,000 in their savings and term deposits, and their super sits at around $90,000. They feel secure, but inflation in Australia has been averaging 3 to 4% recently. With the RBA cash rate sitting at 4.1%, their real returns after inflation are barely 1 to 2%. This means their money is growing, but it is just barely keeping up with the rising cost of living. Think about that for a second. You're doing the responsible thing every month, yet your purchasing power is almost standing still. A dollar you saved 10 years ago can barely buy what it used to. By age 45, they maybe have $190,000 in savings and $250,000 in super. They start to notice their friends who invested differently are pulling ahead. By age 60, they've accumulated roughly $500,000 to $600,000 total. Since the Association of Superannuation Funds of Australia suggests you need around $630,000 for a comfortable retirement, our conservative investor falls short. Security became a cage. Now let's look at the moderate investor. Same starting point at age 25, earning $70,000. However, this person is willing to accept a bit of discomfort for a better outcome. They split their money, keeping an emergency fund of 3 to 6 months in a high-interest savings account, but everything above that goes into a balanced portfolio. They buy exchange-traded funds, or ETFs, like Vanguard's VDBA, or a mix of Australian and international shares. Their super is set to a balanced or growth option targeting 7 to 8% per year. Like the first investor, they also invest $500 a month, but they dollar-cost average into the market. This means they buy in every single month regardless of whether the market is up or down. Some months they get shares at a discount. Other months they pay a bit more. Over time, the average cost smooths out, and they avoid the trap of trying to time the market perfectly. After 10 years at age 35, their investment portfolio has grown to around $95,000, and their super is pushing past $120,000. The Australian share market has returned about 9 to 10% per year on average over the last century, when you include dividends. So the moderate investor is riding the long-term trend of the economy. By age 45, they have around $300,000 in investments and $350,000 in super. They start getting options. Maybe they use some of that equity for a deposit on an investment property, or they just keep letting the math do the heavy lifting. By age 60, the moderate investor is looking at $900,000 to $1.1 million across super and investments. They can retire without stress. They have choices to travel, help their children, or simply stop working because they want to. The gap between them and the conservative investor is now hundreds of thousands of dollars, all from the same $500 a month. The only thing that changed was where they put it. Finally, let's talk about the aggressive investor. Same salary, same age, same conditions, but this person thinks differently. They understand that time is their single greatest asset. At 25, they go all in on growth. Their super is set to high growth or aggressive, targeting 9 to 10% returns. Outside of super, they invest heavily in diversified growth ETFs or even sector-specific funds. They start with investing $500 a month, but as their income grows, they increase it to $750 or $1,000. They also salary sacrifice into super, getting closer to the $30,000 concessional cap and saving on tax in the process. After 10 years, their portfolio is around $130,000, and their super is pushing past $150,000. What most people miss about aggressive investing is it's not just about returns, it's about behavior. This person lived through market dips and didn't sell. They watched their portfolio drop 15% in a bad quarter, and they bought more. That emotional discipline is what separates wealthy people from everyone else. Most people panic when they see red on a screen. They sell at the bottom, lock in their losses, and watch the market recover without them. The aggressive investor sees a dip as a sale. By age 45, they have roughly $600,000 in investments and $500,000 in super. At this point, compounding is doing most of the work. Their money is making more money than their job pays them. That is the tipping point where you stop working because you have to and start working because you choose to. By age 60, this person is sitting on $1.5 to $2 million or more. They didn't win the lottery. They invested $500 a month in their 20s and let compound interest turn it into a machine. The part nobody talks about is that all three of these investors made sacrifices. All three saved money consistently. All three showed discipline. The difference was never about effort, it was about allocation. Where you put your money matters more than how hard you work to earn it. The irony is that the path that feels the safest, the conservative one, actually carries the biggest risk of all, the risk of running out of money when you're too old to earn more. If you're young with decades ahead of you, your biggest danger isn't a market crash. It's sitting on the sideline while inflation eats your savings alive. The super guarantee in Australia is a start, but it's not enough on its own. Use the contribution caps and remember that every dollar you put in before age 40 has the potential to multiply 6 to 8 times by the time you retire. Choose your path wisely.